In today's video, I'm going to show you an example of changing the trading direction during the day because of the setup changes. So let's have a look at this GBPCAD 5-minute chart on October the 29th, which is today. Right after the London Open, we can see the trend is going down here, and then we can easily draw a trend line, and the bottom trend line here. You can see it is a wedge shape. For a wedge shape, normally we are waiting for the trend to break up the top trend line and then goes up. It depends on how you see the pullback. You could place a buy order on top of this bull bar because the bear bar is a pullback, or you wait a little bit more to go down a little bit more here as the pullback, and then you can put your buy order on top of this. This next bull bar is big because there's an event, the Canadian GDP release. So you can also put your buy order on top of this bull bar to trade on the upper trend. At this moment, you can draw another trend line because we have a low here and we have a higher low to see. And then as the trend goes up, but it didn't go much further, instead it goes sideways here with bull bars and the bear bars overlapping each other. And also here you can see it's making this is the high of the day, and then it's making a lower high at a smaller range, another lower high. So this is an indication that the trend is not strong, it's very weak. And then at this bear bar, you can see it's breaking the trend line you just drew, and without respecting it. And then even though there's another bull bar, however, the follow-up is another bear bar. So at this moment, you will think that the upper trend might be over already. If it doesn't go up, that means it goes down. So there's a question, how far it can go down to? So there are two options. The first option is that we have a daily low here. It's gonna go and test daily low. When the trend goes down to lower level to test the daily low, there could be two scenarios. The first scenario is that when it tests the daily low, it goes back up. So it's a range for the day. And then the second scenario is that it continues going down to another lower level. But how far can this go? Since trading is based on the probability, so let's have a look at some probabilities based on the historical data. Based on the historical data for the past 6 months, so the daily range will be 65 pips for 91% of the time. And daily range is 80 pips for 70% of the time. And the daily range is 95 pips for 52% of the time. So this is the daily high. If we take this as the high, and then we calculate the levels for 65, 80, and 95, you can see these three lines here. So at this moment, we are testing the previous daily low, and then you can see that 91% of the time, if it goes down, it can hit this level. And 70% of the time, it will hit this level, and 52% of the time, it could hit this level. So which level you're going to choose, it's up to you and based on your strategy. So as you can see that why it is 91% of the time here, and then there's a lot of consolidation here. That means so people are watching this level. That's another angle to see the whole trading chart. Okay, so hope you enjoyed the video and thank you for watching.